Hi, this is Mike. I'm the Chief Investment Officer here at Lighthouse Financial Services, and I'm with you again for another one of our monthly market update videos. So let's get started. Okay, October 2024. Our talking points today are the following. We're going to size up the markets, both stock and bond, commodities to a limited extent. What we're hearing is that this is the everything rally now. And this everything rally, as I'll show you, is built on improving corporate profits, finally falling interest rates, and a pretty resilient economy. And these are pretty positive points that are going to be tough to break. Rates and inflation are next. We'll talk about the Fed's policy pivot to allow rates to come down, and investors are concerned that hope it's not too late. Hope they didn't start this process too late. And then finally, we'll take a look at the economy again. Soft landing is a reality. It's no longer a debate. And also, I'll point out that the economy is much more strong than we have been told. Okay, 2 years of recovery. This is the S&P 500, and you'll notice this chart marches pretty steadily from the lower left to the upper right. That's what we want to see. This is 2 years, right? Since the market bottomed from that very chaotic bear market in 2022. It's been 2 years, and the market's up, or the stock market is up about 60%. Less so if you're invested in kind of Dow stocks. The Dow is probably up 47 or 48%. This happens to be the S&P 500 up 60. I want you to notice, though, along the way, that there have been some meaningful corrections. We had a 10% correction over the last 2 years, and a few others, 9%, 8%, 5%. So this is a very healthy market, and we call this climbing a wall of worry. This is exactly what you want to see, and it shows that your rally is healthy enough to probably be sustained. Now, there's one other piece of this. If you look under the hood of the S&P 500, that has not been all that healthy until pretty recently. Now, this chart shows the Magnificent Seven, or the 7 top stocks in the S&P 500, and they're weighted the most. So NVIDIA, Microsoft, Apple, Alphabet. These types of names have been sort of high flyers in 2024, and they've really left the other 493 stocks in the S&P 500 behind. But that is beginning to change. So you see this green line as the Mag 7 just explode higher off of the April correction lows toward into mid-July, and a lot of momentum there, huge gains. NVIDIA is up well over 100%, and these Mag 7 names are really heavily weighted within the index. Okay, but you'll see that peak in the green line in July. After that, Mag 7 starts to lose momentum, and it's not so easy to make money anymore, whereas the other 493 do continue to steadily plod along and move higher. This is what we call a broadening out of the rally. In other words, all your gains aren't concentrated anymore in just a few stocks. And just a couple other ways to gauge that. The Dow has done much better since mid-July relative to the S&P 500. And so, are we going to see a continuation of this catch-up? I hope so, because this is another sign that the rally is getting healthier. Okay, the bond side of the equation. I showed you this slide in our last update, and I said it looks like the bond markets found a bottom. A lot of volatility in interest rates, and a lot of sort of placing bets on when the Fed would reduce interest rates and by how much, at what pace. A lot of bets that ended up turning out wrong along the way, along the last couple of years. And so the bond market recovery has been a lot more bumpy than the stock market. But as you can see in this chart, it does look like we are convincingly off the bottom. And this chart, by the way, is the AG, or a really widely held, broadly traded, exchange-traded fund that holds municipals, treasuries, corporates. It holds everything, asset backs. So it's a good sort of barometer of the broad bond market. I'll just point out again, as the Fed started to embark on its interest rate hikes to kill inflation. The interest rates at that time were pretty low, and the yield on this fund was only about 1.8%, as you see on the chart. Now the interest yield that investors can get if they buy this fund today is 3.6%. It's getting much better, and that yield, by the way, is probably rising for this fund. So bonds are a lot more attractive than they used to be, and it does look like they're off the bottom and finally, contributing to what they are now calling sort of everything rally. And this really has been brought about by the Fed's recent decision, and you can see this at the right-hand side of the chart in the orange, recent decision to begin cutting interest rates. What you're looking at here in the orange, this is a Fed cycle, a Fed policy cycle of raising interest rates on the left-hand side, that stair step up to a pretty elevated level of 5.5%, and then holding steady for a while, pivoting and holding steady, no more rate hikes, and waiting for inflation to give, and then finally beginning to lower rates to complete the cycle. And you'll notice that the blue line too, the blue line is a 2-year Treasury note yield. And that gets pushed around by investors. That's not determined by the government. That line is really determined by market action and traders making bets. And you can see that blue line did anticipate ahead of time that first rate cut. And so the 2-year Treasury yield has fallen from above 5% over the last several months to about 3.6, and it will be probably moving lower as well. But the investors have already been sort of anticipating it, but we're finally there. Now, why is the Fed able to finally begin cutting interest rates? Because inflation is making its way lower. And what they're really looking for ultimately is 2% inflation, and that's represented by this dashed purple line. All the other colored lines are different measures of inflation, and you can see that they're all sort of marching lower. Some of them are really close to that 2%. And in fact, if you just take the CPI, or Consumer Price Index, and you strip out some of the more quirky methods they use for calculating inflation within shelter, if you back that out, like rent and cost of rent and shelter, then you're looking at like 1.8%. So even lower than 2. So I think the Fed is comfortable now. We're certainly comfortable now with the idea that the inflation outlook is definitely lower. We might even undershoot the 2% in the near future. Okay, we need to talk about the economy, because there have been some developments here. As you know, if you watched my last video, I showed you this chart, the Citigroup U.S. Economic Surprise Index. This index falls when the economy is losing momentum and the data starts coming in worse than economists are expecting. And when that happens, when you get a precipitous fall like we saw in the spring and in early summer, well, investors sit up and take notice, because that represents a loss of momentum in the economy, and that's what we were seeing. But since then, since July, that line is turned around and it's moving up very sharply. That slowdown was sort of a head fake. And I think, investors have been pre-programmed over the last few years to think about any loss of economic momentum as a coming crash. Oh no, the yield curve says we should be in a recession. The Fed taking up interest rates so high, well, that usually leads to recession. So clearly the economy must be headed lower and much lower, but it hasn't happened. This head fake, what turned out to be a head fake, is now yielding what looks like decent growth. And I think that's compounded by a recent data revision by the Bureau of Economic Analysis. It's a government organization that collects data, and it also calculates how fast the economy is growing. And every once in a while, they'll go back and revise older data as they get more information or change their methodologies. And recently we had a pretty significant revision to the data. And you can see the green line on this chart is the old data that had already been reported, and the big dip right there in 2020. Well, that's COVID crushing the economy. But the yellow line is what I'm interested in, and that is after the revision. It went back all the way to 2019 and started revising data up until the first quarter of this year. And you can see it's pretty uniformly positive each year, actually each quarter in the data. And what's the cumulative effect? Well, that's on the left-hand side there. I show the cumulative real growth. That's after stripping out inflation since the start of 2019 through the first quarter of 2024. Actually 6.3% versus what we'd previously been told was 5.6%. So that's a big deal. The economy's been better than we thought, than anyone thought. You can't help but wonder if we knew this a year or two ago, probably a lot fewer investors would have been calling for a recession. Let's take a look at some CEO commentary. I do this from time to time. It's one thing to look at economic measures and also take an inventory of kind of what narratives are out there in the market, but it's another thing to hear from companies and see how they're doing. And really, at the end of the day, this is what we care about as stock market investors. What we care about is, can these companies that we invest in grow their sales, grow their profits, and generate cash flow? And it's really that simple, okay? And I go back to something that I parrot a lot, which is that if you look back in time, the single most important factor in determining the direction of the stock market is corporate earnings, well, profits. Are profits growing or not, and at what rate? By the way, the second most important determinant of the stock market's direction is interest rates. And right now, you've got both of those going in the right direction. I mentioned a little earlier, we have interest rates are now falling, and corporate profits are rising. I've heard recently that the Mag 7 profit growth for that group of the biggest 7 stocks might be falling just a bit, but profit expectations for the other 493 in the S&P 500 are accelerating. Okay, so back to this slide. Tanger Outlets. Tanger Outlets CEO recently talked about extremely strong Labor Day sales and said the Halloween shopping season is also shaping up to be very strong. Does not see any signs of a slowdown. Paychex is a company that does payroll services, mostly for small and mid-sized businesses. And their CEO talked recently about a very resilient US labor market. Yeah, it may have slowed down just a bit, but he's just seeing the labor market slowing back down to where it was pre-pandemic, which was still very strong. And he said wage inflation's coming down, continues to moderate, but it's not tanking. So Paychex has the finger on the pulse of the most important part of corporate America, which is small and mid-sized businesses, and they're telling us that things are okay. Costco's next. Costco executives have said they've seen some signs recently, unmistakable signs that consumers are a little more choosy than normal in how they're spending their money. They're looking for deals, but on the other hand, their sales growth is still pretty strong, and they just raised their membership fees for the first time since, I believe, 2017, and they're seeing no meaningful reaction from their customers. So that's good to know. Okay, and Carnival Cruise, I mentioned them last time. We'll bring them up again because, again, heard an interview with the CEO who said that they're dealing with record bookings right now and seeing higher onboard spend as well. Mentioned that he thinks the cruises as a vacation class have a competitive advantage right now because they're cheaper than land. And I guess that leads me to take this away. There are a lot of industries, companies that took pricing up quite a bit during COVID and in the aftermath of COVID to deal with inflation. But now that inflation's really coming down, companies need to be more concerned about value. And to the extent that an industry like the travel industry and the hotels and airfare, to the extent that they are not reacting to that search for value and not understanding that consumers are frustrated with higher prices relative to the product that they're being delivered, well, they're going to suffer. And we saw that recently with McDonald's. And McDonald's made a very, very quick pivot back to value meals because their prices, frankly, just got out of hand. And consumers are smart, they recognize value, and that's where we are. So my takeaway from all this corporate commentary is that the economy is resilient, the labor market's resilient, and consumers are willing to spend, but they're only willing to spend where the product represents a good value. So that's a new development, and I think that's just gonna continue. So all told, and I won't show you this chart again, this will be the last time, I promise. It looks like to me that a soft landing has been engineered by the Fed. That is, the Federal Reserve was successful in killing inflation without crushing the economy. And that's the simple definition of a soft landing. We've done it back in 2022. Most investors thought we were going to have a hard landing. And as time went on, kept calling for a recession, but then said, well, you know, it's going to be a bumpy landing. And that's what we told you. Bumpy landing meaning the Fed would be successful, but there's going to be a lot of volatility. Well, here we are in 2024, and it looks like a soft landing. And I think we can put this to bed. All right, so most of what I've said has been pretty positive, but that's not what you're hearing when you tune into the media, and that includes the financial news media. Here's what you're reading. Not very much of it is positive. It has to do with escalating geopolitical tension in the Middle East. It has to do with corruption charges, high-profile politicians, and fears about the upcoming election, and even a major hurricane. So I'd like to say this about that. Investors make up the stock market, right? It's buying and selling. The stock market, and I'll move back to this chart. The stock market is not panicking. Yes, it's climbing a wall of worry, but you have to wonder if you're hearing all kinds of negative things and you see these risks, geopolitics and domestic politics in the news media, but the market's not reacting, is that because we're whistling past the graveyard? Or is that because the risk is judged to be negligible or rather low? And I think it's the latter. I don't think investors are whistling past the graveyard at all. You know, these issues, these risks are always going to be present in the market, always. If it's not Middle East, then it's saber rattling from North Korea. Or it's fears that China will invade Taiwan. There's always going to be something. And I think, you know, if I were a short-term trader, I might be a little bit concerned because we could very well see another correction or a dead spot in the market. Yesterday, kind of a little bit of a dead spot in the market, no question. But if you're a long-term investor, these types of risks, statistically, if you look back in the past, do not generate long and significant downtrends in the stock market. And and by contrast, well, along with that, I guess, they also don't usually generate long and sustained uptrend in bond markets. You know, you don't see a lot of panic being sustained. You see short-term moves by traders, but order is typically restored pretty quickly. And I'll just remind you of something I've said before. If you look back at the January 6, 2021 event with the Capitol, that was a pretty outsized event. It was a pretty dramatic event that should have had a big impact on markets because, as you know, as we kept being told from the news media outlets, this is a severe threat to democracy in this country. Well, the stock market didn't really move. It didn't really register on the Richter scale there. And the reason was because investors quickly assessed the situation and realized that the long-term risk was absolutely low. This was a very short-term event. So I'll say, you know, the news media and sometimes just investors in general don't do a great job of understanding and then expressing the nuance that comes along with investing. Nuance meaning that yes, these risks are out there and we always have to be assessing them, but they don't always have to end in an absolute, you know, a bear market, 20% or a 30% dip in the stock market that lasts 1 or 2 years, and in a concomitant, you know, economic recession. They don't typically result in big moves. You know, if you knew ahead of time that one of these risks that are shown on this slide would lead to a 5% correction, which would be quickly bought up, you know, within a week or two, and then you'd head to new highs. If you knew that, would you panic and go to cash? No, absolutely not. Just from my perspective, these definitely are the risks du jour, but they are not enough to derail the positives that I mentioned earlier. And I'll just recap them real quickly. You've got rising corporate earnings expectations. You've got falling interest rates, and you've got a current economy that looks to be gaining some momentum rather than losing momentum. And those three factors are going to be pretty powerful, and in my view, will continue to drive the rally going forward into next year. Okay, I want to thank you for watching, and any comments you have, let us know. But we'll be back in about a month with another market update. Thank you very much.